Hello and welcome to the latest special edition of the Sharesify podcast. Today we are delighted to be joined by Richard Shepherd-Cross, manager of the FTSE 250 real estate investment trust, Custodian Property Income. Richard, thank you for coming on the show.
Thank you very much.
Now, you've a busy week because you're publishing your annual results this Thursday. Obviously, for compliance reasons, we won't be talking about those. But I thought, as it's the first time we've had a REIT manager on the show, before we get into the details, could you just explain to the viewers and listeners what is the difference between a REIT and a property company, say like a land securities?
Well, I think the first thing to say is that there is clearly a confusion. The very fact you've had to ask the question points to that. A REIT, a real estate investment trust, is in fact a tax status. And that tax status means that the company doesn't have to pay corporation tax. And as a quid pro quo for not paying corporation tax, it has to distribute 90% of its rental profits to shareholders. So, as that suggests, it is an income vehicle. It is designed to get rent through dividends into the hands of shareholders as tax efficiently as possible. So the difference between the two different structures are that you have trading property companies that tend to be internally management, so the staff, the directors, the IT systems, the HR department, the directors' bonuses are all a direct cost of the company before shareholders are paid a dividend. In an investment trust structure, and here is the confusion because they're all real estate investment trusts from a tax perspective, but the investment trust structure tends to be externally managed. So there is a board of directors who look after the shareholders, and that board of directors appoints an investment manager to manage the trust on behalf of the directors for a fee that is normally a percentage of net asset value. And we are the latter.
Brilliant.
So we are an externally managed property company. We're all REITs. That's the tax status. And quite honestly, we could all have done better in explaining this by not all using the same terminology for a different entity. Fundamentally, it's just the style of management. It shouldn't be a huge difference for investors.
All right. That's great. Thanks, Richard. Now, you've had a great deal of success attracting retail investors over the last couple of years. Why do you think retail has decided to include commercial property in their portfolios?
There's a one-word answer to that, and it's income. But I think you probably want more than one word from me. Why do retail investors like income? I think that's perhaps self-evident. Why do they like income from real estate? Well, I think particularly in the UK, we have a national obsession with real estate, be it flats and houses or commercial property. I think retail investors take huge comfort from the fact that they are investing in a tangible asset, an asset that they believe quite rightly will be there in 10, 20, 30, 50 years' time, still producing an income. They understand that in an inflationary environment, owning real assets gives you a natural hedge against inflation. And that hedge in the case of real estate comes from rental growth. And we've seen that very direct link. After many years of virtually zero interest rates and very low inflation, in some ways, property couldn't really shine. It couldn't really do what it's best at doing, which is providing a real income over the long term. And we've seen that following a period of high inflation, and I don't think we're quite through it yet. Real estate has reacted with rental growth. And if we look back in our portfolio over the last 5 years, we've averaged 3.75% per annum rental growth. That is preserving the value of investors' money. So I think they have added commercial real estate into their portfolios because they are savvy. We have certainly seen in the very recent past people selling out of buy-to-let residential investments and see commercial real estate investment trusts as a very good alternative. And I think for many of them,
That's interesting.
they understand, perhaps having not really looked at commercial property before, that they can get double the income return with none of the hassle.
Mm.
Right. Yeah. And in terms of structure as well, is the closed-ended fund a better option for small investors than an open-ended fund?
Without equivocation, absolutely yes. And the evidence is for all to see. The open-ended funds for retail investors have pretty much died, and that's a good thing. They were, in the words of Mark Carney, they were built on a lie. The lie was that you could have daily liquidity in a real estate investment. Well, of course, if you looked at those open-ended funds, and thankfully this is history, but as a history lesson, if you look at those open-ended funds back in the day, they were probably 60% invested in real estate. The rest they were holding in liquid assets to deal with day-to-day liquidity. So you weren't getting liquidity in real estate. You were getting liquidity in the liquid assets of an open-ended property fund that was underinvested in real estate. And as a result of being underinvested in real estate, they paid low distributions and had very poor total returns. So yeah, the closed-ended structure, you need a permanent source of capital to invest in long-term assets, and real estate is a long-term investment. Yes, of course, you can make returns over the short term, but my advice to anyone, and clearly I don't give advice, would be that you should consider a 5-year minimum horizon for any real estate investment. I mean, after all, we only get the chance to renew a lease, increase rent at rent review once every 5 years. So you can't expect extraordinary performance in very short time frames.
Richard, I think it's worth explaining to people also that you have a very specialist approach in the type of property that you invest in. And I remember about a year ago when you presented, you said you'd asked ChatGPT, why REITs were trading at a discount, and you actually allayed most of the issues that it raised then. How does the market feel to you now in the particular markets that you're active in?
The occupational markets are really good at the moment. I mean, as I mentioned before, average 3.75% rental growth over the last 5 years. That isn't abating. We are seeing lower vacancy rates, continued rental growth, a recovery in prime high streets, and they were on a downward path for probably 6 years. That has turned around. Prime offices, again, there's strong rental growth for the right assets there. And if you look at the consensus forecasts from the real estate industry of where returns are going to be, they are showing positive total returns in every asset class. That's
Really?
the first time that's been the case, because this is a quarterly consensus forecast that's run by an investment property forum, and over recent quarters and years, we've seen offices and retail showing negative total returns. All sectors have returned to positive, and this is a supply and demand driven phenomenon. There is an absence of supply of good quality property with low environmental impact. Those are the sorts of properties that tenants are looking for. And where those properties do exist, then we're seeing rental growth. Interesting you should mention ChatGPT, because I did re-ask the question, and it gave me the same old guff that I'd heard before about higher interest rates, weak economic expectations, all of which I get. It's still banging on about people not working in offices and retail struggling. So I think it needs to catch up. So I then asked a supplementary question, which I thought was perhaps more telling. And the supplementary question I asked is should investors look at net asset value or earnings when investing in UK real estate? Because to focus on net asset value is to focus on the discount and to confer discount. A broad discount suggests there's something either wrong with the property or it's too the property company, or it's too cheap. What ChatGPT said was that it is dangerous to rely on net asset value alone, and that experienced investors should start by looking at quality of assets. And I know that that is a tough judgment for people who perhaps don't understand real estate markets in depth, but start with the quality of the property. And often the very best way to do that is to simply look at the pictures of the properties that are are held in any fund. And I think investors would be surprised how good their judgment is simply by looking at the buildings. Then look at the balance sheet, then look at earnings, and the final thing to consider is valuations, net asset value. So it still has merit, but it's not the key determining factor. So well on ChatGPT, I think it's keeping pace, but of course, as is so often the case, you've got to ask the right question.
You've got to ask
but I
the
think
right questions.
Earnings, balance sheet, quality of property, and for the ones, if those, the two that are perhaps easier to assess are earnings and balance sheet. So that's where I would start.
Brilliant, thank you. James, I think you were going to ask about how are you finding new investments?
Yeah, exactly. Just a bit more detail on how you go about finding those new investments, and perhaps are there any sort of other areas you haven't mentioned that look interesting right now in the market?
We've been very focused over the last 12 months on growing Custodian Property Income REIT through corporate acquisition, and that has been private property companies. We've acquired 3 in the last 12 months, 67 million of gross assets. There are, for the private property company, compelling reasons why a property for share swap, which is how we've been doing these deals. So rather than buying them with cash, we've been using the paper, the shares of Custodian Property Income REIT. These deals have been done on a net asset value for net asset value exchange ratio. So we paid fair value for the properties we're acquiring with the value of our properties. That's enabled us to grow our portfolio at a time when we think it's a great time to buy property. It feels like we've hit the bottom of the property market cycle, and we're not roaring away because we've got geopolitical noise that is dampening down enthusiasm, but it feels like we're on an upswing, not a downswing, which is a nice place to be, and a good time to be investing. So we've been able to grow our portfolio by issuing new shares and securing very often family property companies. And for the family property companies, they have been able to transfer their assets gross of tax, because as a real estate investment trust, we don't pay corporation tax. We haven't paid stamp duty land tax because we bought the share capital, not the underlying assets. And we think there are tens of dozens of these opportunities out there. Very often these companies run by the older generation who can't pass the assets down to the next generation, either because they're too numerous and the portfolio doesn't divide easily, or because the next generation aren't interested, and perhaps there's no reason they should be. Everyone needs to follow their own dreams in life. But the senior generation can't run it forever. So there comes a point when by switching those direct properties into liquid shares, they then have an equitably divisible asset they can pass down to the next generation, and it's a managed solution. We're now managing their properties. They get 4 dividend checks a year, and they don't need to worry about the day-to-day running of the company anymore. So it's really neat. We think there are many more opportunities out there. As is always the case, these opportunities come through property advisors, so property agents, many of whom have been advising these companies for many years. And that's been our focus.
Richard, that is fascinating. And that sounds like a real win-win for everybody there. Thank you so much for your time. It's been absolutely great. As I say, I realise you're busy, and everybody keep an eye out for those full year results, which are out on Thursday. You'll find all the details on the website, custodianreit.com. With that, again, Richard, thanks very much for coming on the show, and we look forward to seeing everyone soon.
Thanks both.
Thanks. Bye.
Bye.
Thanks.